Today we're going to be debunking the myths of life insurance. If you're trying to research the pros and cons of permanent life insurance, you've probably come across a lot of conflicting information on the internet as you've done your research. Some people tell you it's the greatest thing since sliced bread, other people tell you it's a ripoff, but without ever really telling you why. If you're brave enough to actually tell a group of people that you're thinking about buying a permanent life insurance policy, without a doubt, one of those people will shout out that it's a ripoff and that you shouldn't do it, you should buy term and invest the difference. But even right there is a tacit acknowledgement that the death benefit of a life insurance policy has some value. They just don't think that you should be buying a permanent life insurance product. They think that you should buy term and invest the difference. But as you know from watching some of my other channels, that in a permanent life insurance policy, you are buying term and invest the difference. That's what the insurance company is doing under the hood. So this video is geared towards those of you who are reasonable. I don't expect to be able to change the mind of the haters. But for those of you who are reasonable and know that the truth lies somewhere between the two extremes, this video is for you. So please stick around after the intro video and we're going to dive right in. Hi, I'm Tom Rutkowski with Innovative Retirement Strategies. I'm a bit of a financial nerd, so things like compounding interest and interest rate arbitrage fascinate me. And I came up with the double play years ago on my own when I discovered that I could build an overfunded life insurance policy and borrow against the cash value to do my real estate investing. And I want to share what I've learned and the power of life insurance with all of you. So the goal of this channel is to give you all the information that you need without ever talking to an agent to get the most efficiently designed policy so that you can maximize your wealth accumulation through the effective use of the double play. And the double play, of course, is putting your money to work in two places at one time by leveraging the cash value of a maximum funded life insurance policy. So in this video today, we're going to bust all the common myths of life insurance and try to get you, with facts and data, the information that you need to make a decision and sort through what's fact and what's fiction out on the internet. All right, so let's take care of some formalities. Nothing in this presentation constitutes financial or tax advice. And the primary reason for purchasing life insurance is for the death benefit protection. Any other benefit is ancillary. The purpose of this content. So we're going to talk about 6 common myths of life insurance today. I actually have a blog post on my website titled Debunking These Life Insurance Myths, and in it I cover 5 myths. But I was having a conversation with one of my clients yesterday, and we were talking about the myth that the rising mortality costs in a universal life or index universal life policy could cause the policy to lapse. And I thought, that's not one of the 5. I was actually going to come back and deal with that one separately in its own paper. But in the interest of having this session be valuable and all-inclusive, I just thought at the last minute I'd add that one in. So we'll cover that one. It might be a little rocky because I threw it in at the last minute, so I apologize if things don't flow very well. But the common myths are, first off, life insurance is a ripoff. I'm not even sure what that means, but I'm going to take a look at it from the perspective of life insurance or high cash value life insurance as an investment. Typically, we look at, if everybody recommends, buy term and invest the difference. Second one is it takes forever to build cash value. The returns are too low. Dave Ramsey's favorite, why would I borrow from myself? The life insurance company is going to keep the cash value when I die. I hear that one all the time. And finally, the rising mortality cost is going to cause an IUL or UL to lapse. Let's dive in and start talking about the first one. Whole life insurance is a ripoff. The first thing is it's important to keep in mind that all life insurance policies are not the same. In previous videos, I've talked about minimum versus maximum overfunded policies. So they're not the same. And if we think of life insurance as an investment, what everybody always says is buy term and invest the difference. So let's take a look at it from that perspective. Just the fact that they're acknowledging that you still need term means that they're putting value on the death benefit protection itself. but they're just telling you that you should be investing in something else besides the life insurance in order to do the difference. The best way to cover this is to start with a little bit of the basic life insurance 101. Okay, so I highly recommend you go out and watch the video on Life Insurance 101. I've got a paper on my website titled Life Insurance 101. Both are great resources to learn the basic fundamentals that you need to know in order to understand the double play. So in a permanent life insurance policy, what you think of as a very expensive premium is actually going into two different places. So this chart is showing a minimum funded life insurance policy. So this is your typical whole life or guaranteed universal life. Both are designed for maximum death benefit per dollar of premium that you're putting into the policy. So the goal is not cash accumulation in these policies, it's getting the most bang for the buck. So the insurance company, you have to put yourself into their shoes. You know, if you were an insurance company, how would you design a permanent life insurance policy? So the way I would do it is I would have that premium designed such that the insured or policy owner would be saving up the death benefit, assuming some worst case interest rate assumption over time, so that by the time they reach their natural life expectancy, if you had a $1 million death benefit, then you would save up $1 million by that time. So clearly, if the cash value actually grows faster than the minimum worst case assumption that you're assuming, then the cash value will reach the death benefit sooner. In which case, it pushes the death benefit up, as is shown in this graph where the circle is. But you also have the risk of the person dying. So during the very first year, if you look at the bracket on the left, for example, if the person were to die at that time, the insurance company would have to come out of pocket for nearly the full $1 million. So what's happening is the life insurance company is quite literally pooling the money it takes to pay all the expected claims, or essentially buying a 1-year term policy on the life of the insured. So you could think about it. I mean, if you were starting up your own insurance company, you would design this savings component, and since you don't have enough people in a pool to cover the risk, you might go to a reinsurance company and simply buy a 1-year term policy on that person's life to cover them through that year. The next year, they've got a little bit more cash value saved up, you buy another 1-year term policy. And that process repeats itself, and over time, the risk to the insurance company is going down because the cash value is going up. So is this policy a good investment? Well, if you're trying to maximize the death benefit protection per dollar that you're putting into the policy, then yes. Could you do this yourself? Sure. If you saved up your own money, it would be occurring in a taxable environment. So the insurance company, they're putting their money into nice, safe debt instruments. They buy U.S. Treasuries, they buy bonds, they buy tons of mortgages from the insurance companies. If you did it, you might put it in the stock market. But if this week is a good example, and for anybody watching this later, this is the week of the coronavirus and the market's not collapsing, but taking a significant hit. But the money may not be there when you need it. So like if we look out at age 79 in this graph, you see that at that point in time, the person has saved up about $500,000, and there's an additional $500,000 of risk to the insurance company. So if you had saved up your own money, maybe you would have had more, but you got the volatility of the stock market to keep in mind, as well as the fact that every year from the beginning through that age 79, which is about 44 years, you've been paying income taxes on the dividend income of your holdings. And when you sell, you're going to have capital gains tax on the entire value of the portfolio, minus your basis, of course. In the life insurance policy, that is occurring in a tax-free environment. It's not an investment fund per se, it's just the life insurance policy. So there's a huge tax advantage, but again, we're not looking at this whether it's an investment or not, it's whether or not the death benefit can be had at the best possible price. And at that age 79, for example, had you bought a 30-year term at age 45, well, it would have expired at age 75. So at that point in time, this person wouldn't even have any death benefit protection. That's the minimally funded policy. Again, the goal here is maximum death benefit, not cash value. If you're designing a policy where the goal is cash accumulation, so that you can do something like the double play or any other private banking strategy, you're going to design a maximum overfunded life insurance policy. And here, this is showing what the policy looks like when the client's putting in $100,000 of premium each year for 10 years. And then after the 10th year, we're reducing the death benefit to drive all the costs out of the policy. So what do I mean by the cost? Just as in the last example, the insurance company is responsible for the delta, the change or gap between the cash value that the person has saved up and the death benefit. So clearly that risk to the insurance company is where most of the cost is in offering a policy. So during those first few years from age 45 to 65, when that person puts in a $100,000 premium, you can see it's resulting in about $2.5 million worth of death benefit. And as they add additional premium in subsequent years, it's pushing up that minimum increment of death benefit protection that we have to have according to law. But that risk doesn't need to be there for the person's entire lifetime. So when they turn 55 and they're done funding life insurance policy, now we want to preserve the cash value, because maintaining $2.5 million worth of death benefit on top of the cash value has a cost. And if the insurance company is dipping their hands into the cash value each year to pull out enough to essentially buy that one-year term policy, it's eating up or consuming the cash value. So in this example, the sliver that you see, the narrowing sliver from age 55 all the way out through 93 is the minimum non-MEC corridor. So that's the minimum amount of risk that has to be covered by the insurance company to maintain the definition of a life insurance policy. And if you look at the cost of that one-year term policy, or the amount of money that needs to be pooled in order to cover the mortality risk, that cost is only 1/4% of the cash value. It's actually even less than that. I mean, if you get your illustrations out, if you've ever had an insurance agent run one for you, and look at the cost of insurance outside of the years where you're funding it after the death benefit has been reduced, and if you do the math, you'll find out that it's less than 1/4% of the cash value. And I mean that's on par with index mutual funds and how they operate, their expense ratios. I'm going to kind of jump ahead to the last myth here, and we're going to talk about it a little bit in advance while I have this chart up. So that if I'm saying that the cost of the death benefit protection, the mortality cost, is 1/4%, do you really think that the myth of rising mortality costs can possibly be true? So let's kind of break that up into two things here. If you look at that sliver very closely, you can see that it gets narrower as time goes on. And again, that's the cash value represents you saving up your own death benefit over the course of your life expectancy. So you'd expect that those two lines converge as you get older. So two things are going on here. As you get older, certainly the cost of insurance is going up. $1 of death benefit protection costs more at age 93 than it does at age 55. But since the corridor of risk is getting smaller, there's less death benefit being purchased. And that's why if you look at any point along that curve from age 55 all the way out through 93, you break out a calculator and you do the math, you're going to find out that the cost of insurance as a percentage of the cash value is remarkably consistent right at 1/4% of the cash value. So the myth that the rising mortality costs are going to cause the policy to lapse is just that. In a properly designed policy, not going to happen. Now, that said, it's all a matter of degrees. If we left the death benefit at $2.5 million over the cash value, that cost over time is going to get much more expensive. And that could start consuming the cash value. So in the situation I've shown here, where the cost is 1/4%, well, if you're earning 3% on the cash value. That still is a net of 2.75% after you take out the cost of insurance. And that's assuming that the market goes nowhere. So if the market earned zero that year and your IUL didn't credit any interest, you would have taken a step backwards by 1/4%. That could happen for many, many years before that would have an impact on the policy's cash value and put your policy at risk of lapsing. But if we left that $2.5 million of death benefit protection in there, that would be a different story, wouldn't it? So the problem here is twofold. One, you've got bad agents who don't tell their clients that they need to make that policy change once they're done funding the policy. And two, even if the agent did tell the policy owner that they needed to make that change, oftentimes at 10 years in the future, that person is saying, well, I kind of like having that $2.5 million of death benefit protection. But you have to understand, if you're funding a policy for only 10 years, you're not really putting enough premium into the policy to justify the cost of that risk over the course of your entire lifetime. It would need to look much more like the minimally funded policy design. So hopefully that makes sense. It's going to be a little redundant. I'm kind of covering a little out of order, but we have this slide up on the screen right now, so we may as well talk about it. So some of the resources to back up this information, I've got the Life Insurance 101 paper on my website. That's available as a download. I've also got a paper on a blog post on the minimum versus maximum overfunded policies. We had the webinar on it last week, and that's being converted to a video for YouTube as well, so that'll be out there. And then I've also got a blog called Should I Buy Term and Invest the Difference? That discusses essentially everything here in this presentation, except for the fact that it doesn't have that last one, which is the rising mortality costs in an index universal life. We haven't left the subject of buy term and invest the difference yet. We still need to look at the income. So if you're going to buy an investment, you're buying an investment for future retirement income. People put money into, people blindly put money into 401k plans year after year after year without ever really thinking about how much income they can generate from that savings when they get done. People are always looking at accumulation values, mark what they see on their statements, and not how much income. And income is what's really important when you retire. Back in the old days, companies offered pensions. Well, the employees didn't need to save up any money towards retirement because they had that income coming in. And in the comparison of life insurance to traditional investments, it also comes down to income. And it's important to understand that a life insurance policy can generate income at an 8% ratio compared to 4%, which is the rule of thumb that most financial advisors use for the safe withdrawal rate from funds in a traditional brokerage account or retirement account. To put that in perspective, if you've saved up $1 million in your IRA, assuming the 4% rule, that means that you could take out $40,000 a year and expect that money to last for the rest of your life without ever running out of money. But keeping in mind taxes, in a traditional IRA, you have not paid your taxes yet, or traditional 401k for that matter. So if you're in a 25% tax bracket, that $40,000 gets whacked down to $30,000. So for every $1 million of savings that you have, $30,000 a year is the after-tax income that you can expect. Now, life insurance can provide 8%. Now, sometimes I'll get a little more conservative. If you want to be able to adjust that for inflation each year, I would say 7% or maybe even lower than that is what you can safely take from a life insurance policy every year for the rest of your life, no matter how long you live. So if we, on $1 million, assuming the 4% rule and tax as an IRA, that $40,000 would be taxed, you'd end up with $30,000. That's comparable to $80,000 that $1 million of cash value in a life insurance policy could generate. So the life insurance policy is actually capable of generating 2 to 3 times the income from the same amount of savings. So the first thing a hater is going to say is, well, life insurance is not going to grow at the same rate as my investments are. And what we're looking at on screen here is a comparison of A policy being funded, I believe this one was $20,000 a year for a 40-year-old, being funded all the way out through age 65. In fact, I think you can see a little bit of a gooseneck there at age 65 where the curve starts to change. So clearly, if we assume that the blue line being the investments is growing at 9%, and the dividends are being taxed as ordinary income, and the body itself has capital gains tax, then the investments will accumulate more over that person's lifetime. But that's just a number on a piece of paper. So every quarter you get a statement from your broker showing how much you have in your 401k or your own savings plan. But that piece of paper and $5 is still what it takes to buy a cup of coffee at Starbucks. The piece of paper doesn't put food on the table. The piece of paper doesn't pay your bills. So you've got to sell something in order to generate income. Income is what matters when you retire. So in the next slide, here we're looking at income. How much income is capable of being generated by those funds? So while the traditional, or what I call status quo on this chart, had more money in it, if you can only take income at a 4% rate, that's shown here. So the way to interpret this chart is if I put the mouse here on 65, age 65, that person can take roughly $60,000 a year for the rest of their life. That's the way the 4% rule works. If they put off retirement until age 70, they'll have a little bit more savings, and they might be able to take something closer to, looks like about $75,000 a year. But you're spreading that income over a shorter remaining lifetime. Now, cash value, on the other hand, if we look at age 65 again, is capable of generating nearly $100,000 a year tax-free. So that's a significant difference in income potential. It's not exactly 2 to 1, but it's a substantial difference. I've got a link that I'll put in the description below to a paper on the 4% rule. But if you just Google the 4% rule, you'll find that nowadays most financial advisors don't even use the 4% rule. They've used something closer to 3% just because of the market volatility over the last 20 years. The 4% rule is kind of thrown out. I use it just to be conservative. I'm giving traditional investments the benefit of the doubt when they're competing against life insurance. I've also got another blog post on my website called Tax-Free Income from Life Insurance, which describes exactly how this works and why it works. Myth number 2 is it takes forever to build up cash value. Let's go back to the maximum overfunded life insurance policy design. So in this example, this was a client putting in $100,000 a year for 10 years. Well, it's kind of hard to see because of the scale here, but out of that $100,000, there's probably about $85,000 of cash value that's liquid on day one that person could turn around and use as collateral for a line of credit from a bank, or they could get a policy loan from the insurance company themselves. And as my clients know, going to a bank and getting a line of credit secured by your cash value is the way to do the double play. So I think myth busted. Myth number 3, the returns on life insurance are too low. In today's market, Penn Mutual, Mass Mutual are both paying over a 6% dividend. I don't know about you, but that beats what I can get on a CD in today's market. It beats money market rates by a long shot. And the real beauty of life insurance is that the life insurance company is investing for the long term. They're matching up their investments with their liabilities. So they're purchasing long-term debt, they're holding securities through maturities in order to capture the highest possible yield to maturity. But you get the beauty of that because you can take a policy loan against it. Now, if you invested your own money for long-term returns, that money might be tied up. If you put it in the stock market, like this week, for example, you may not be able to sell it because it's down 20, I don't know what the markets are actually down right now, but it's quite a bit. If we look back at 2006 and 7, for example, the markets were down 40% during those years. Well, a lot of times if you're counting on that money, like for kids' tuition, you can't access it. It would wipe out everything if you tried to take out that money. But with policy loans, you're earning a long-term rate of return, but you don't have those volatility and liquidity issues. You can take a policy loan against it at any time. So from a risk versus return perspective, life insurance offers an amazing rate of return. So again, I'd say myth busted on that one. Myth number 4, why would I borrow from myself? This is a Dave Ramsey classic. Why would I pay money to borrow from myself? Hopefully, I've made it clear as we've gone through these presentations, any one of my previous videos, you're not borrowing from yourself. A policy loan is a loan of the insurance company's money secured by the cash value of your policy. So your cash value never leaves that life insurance policy until you die. I mean, it never leaves unless you surrender it. So those are 2 options. Either surrender it or die. But when you take a policy loan, the insurance company is making a loan to you with your cash value as collateral. Now, if I want to go down another rabbit hole, I mean, I've seen people post on different forums that, policy loans are bad because if the interest rate on the loan is 8% and my cash value is making 6%, I'm going backwards every year. Well, that is absolutely true. But that doesn't mean that policy loans in themselves are bad, because with most of the indexed universal life policies that I use, even the whole life policies that I use, the interest rate on the loans is determined by the Moody's Corporate Bond Index average. So loans today are anywhere from 4 to 5%. And the cash value, Mass Mutual and Penn Mutual, again, paying over 6% dividends. So your cash value can literally grow at 6% while you're borrowing money at 5%. That's not going backwards. That's actually taking a 1% step forward. So it's all in a perspective. It's a matter of degrees. One person's bad investment, well, if they're looking at different data, they're going to come to a different conclusion. But if you can put money into a policy where the cash value can grow at 6 to 7%, like an indexed universal life can, and you can borrow at 4% in today's market, that's an opportunity to put multiple percentage points of positive interest rate arbitrage on the table. And that's huge. That's one of the things that makes the double play so amazing. So here again, myth busted. Myth number 5, the life insurance company keeps the cash value when I die. I don't even have any slides prepared for this one, because as you no doubt learned as you've gone through this, the cash value represents you saving up your own death benefit over the course of your natural life expectancy. So if you have $1 million death benefit, it's not like the insurance company is giving you $1 million of insurance money and keeping the cash value. Your cash value is a part of that $1 million. And every year as your savings increases, their risk is going down. So they're just responsible for the difference between the $1 million and the amount of savings that you have. So I hope that's clear by now, but we still needed to cover it. So myth number 6 is the rising mortality costs will cause an IUL or UL to lapse. We covered that a little bit earlier, but let's just cover a few more things. It's important to understand that both whole life and universal life, all insurance companies rely on the exact same mortality tables. So mortality costs aren't something that's unknown. I mean, I often hear people say, well, the cost of insurance isn't guaranteed. Well, the thing is in the insurance companies, if they're using the same mortality tables, they know what it's going to cost to have $1 million of death benefit protection 30 years from now. They know what that is. They know how much they need to save. So the real change or variable factor here is how much cash value there is. So if we look back at the minimum funded life insurance policy example, there's always that gap between the cash value and the death benefit. We don't know what that gap is going to be. So if I do an insurance projection, an illustration, and it's showing 6% growth, for example, then I'm showing the cash value being at, let's just say, $500,000 by the time that person reaches age 79. If it grew at a rate better than 6%, then that blue curve would have been up higher, and the amount of risk of the insurance company would have been lower. Or if it grew at a lower rate, it would have been at a lower rate, and the cost of insurance actually would have been higher. So it's not the cost of insurance that changes. I don't want to misspeak here. It's that gap that is constantly changing based on the performance of the cash value that changes. So point number one is for two identically designed policies, whole life and universal life, indexed universal life, if they both collect the same exact premium, let's just say $20,000, they both have the exact same death benefit, $1 million, both companies are facing the exact same risks and liabilities, and they're using the exact same mortality costs. So the only real difference comes down to what the cash value does. And if the cash value in an index universal life is capable of capturing some of the equity premium over the typical debt market return that a whole life is capturing, the index universal life is going to have more cash out in the future. And the amount at risk of the insurance company is going to be smaller. So this myth that the rising mortality cost is going to cause a policy to lapse is just that. It's a myth. Now, everybody's going to say, well, I knew people whose policies lapsed because of this. Again, if you look at the maximum overfunded design, if we're doing a short pay and we're only putting 10 years of premium in there, that person cannot leave that death benefit at $2.5 million over the cash value. So again, it comes down to the agent educating the client on what they need to do to have the policy perform as illustrated, or it's up to the person. I mean, they could make a conscious decision that I want to keep that death benefit protection, in which case they need to understand that the policy may run out of money at some point in the future. This is also true on a whole life. So on this blue chart of the increasing death benefit, I don't show on there whether this is an index universal life or a whole life. That chart is true for either one. When I do a whole life illustration, for example, I need to bundle together a base whole life policy, a term rider, and paid up additions rider. The base policy of a whole life is going to be like the minimally funded policy design on the left. It's going to be starting from zero cash value and accumulating over time. So in this example with a $100,000 premium, let's just say that $10,000 of that premium goes towards a base policy. And let's just say the death benefit on that base policy is $500,000. Well, in order to stuff the other $90,000 into the policy, we need to get the death benefit up to $2.5 million in order to not violate the insurance rules. It has to look just like the overfunded IUL. So the way I do that is I spend, let's just say, $1,000 of that $100,000 premium on a term rider that's buying about $2 million worth of death benefit. So now that I have $2.5 million of total death benefit in this policy, now we can stuff the other $89,000 of paid up additions into the policy. And the paid up additions have a little bit of death benefit too, so you can take that into account and buy less term. But rising costs and mortality causing a policy to lapse. If that client doesn't take that term rider off the policy, it's not going to look like what is shown in that blue chart here. The client, that term rider may cost $1,000 a year at issue, but each and every year that $2.5 million of $2 million of term is getting ever more expensive as you get older. So again, if that person likes that death benefit and doesn't want to get rid of it, that rider will consume all the cash value. And that's a whole life. So it really comes down to a matter of degrees. Will the rising cost of mortality cause a policy to lapse? Only if it's not designed right. Only if you've got a bad agent who didn't tell you how to manage it. Only if you made a conscious decision to. It's kind of like I don't know, I'd call it a race car. I mean, it's got a lot of power, and if you don't know how to use it, it can cause an accident. And universal life gives you that flexibility to do these things. But it's really incumbent upon the person to be educated and work with an agent that understands the product that they're selling and can explain the risk to you so that you get the right policy. Again, and the last bullet point was the cost of insurance in a minimally funded design. MEC scenario is less than 0.25%. So hardly in the realm of an amount that's going to cause a policy to lapse. So conclusion, the main thing I can say here is that it's a matter of degrees. When it comes to buy term and invest the difference, it really depends on whether you're buying a policy for death benefit protection or for cash accumulation. And remember, anything on an entire spectrum is available. I can always increase a little bit of death benefit and keep the premium the same. But it's important to work with an agent who understands the product that he's selling, or she, and can explain it to the client, and that the client knows what they need to do at any point in time. So to a certain extent, some of the things are true. Yes, a rising mortality cost could cause a policy to lapse if it's not designed right, if the person doesn't make the right steps. I hope that addresses everybody's concerns. So please let me know in the comments section if there's any myths or misconceptions about life insurance policies that I missed and that you'd like me to cover in a future video. Otherwise, if you're hungry for more information, go online and join my Facebook group. That's The Double Play. And that's a community of real estate investors who are using this life insurance strategy to put their money to work in two places at one time by leveraging the cash value of a maximum funded life insurance policy. Also, look in the description below for links to all of the papers and videos that I referenced in this video. And lastly, be sure to grab the paper titled "This One Policy Design Mistake Can Cost You Thousands." In it, I discuss how life insurance agents can unknowingly make a policy design mistake that could cost you thousands and think they're doing you a favor at the same time.